Good morning, everyone. We are recording this session. Thank you so much for joining us. My name is Anita Eliason, and I'm a senior business advisor with the Massachusetts Small Business Development Center. We are so excited to bring you this webinar about understanding financial statements. And Rob Morton is an amazing presenter, and he is a 36-year veteran of the accounting world with a master's of science in both accounting and taxation, and a bachelor's in accounting as well. And what we enjoy most about Rob is that he explains financial statements in a way so that we as small business owners can really utilize the information to get us to that next level of financial growth. And someone said not too long ago that finances are the language of a business, and I think that Rob does a really excellent job, and that is why he was a teacher at Bay Path in Western New England and teaches in their master's program, because he just uniquely delivers the information in a way we can understand it. He's graciously offered that if you have any questions, to please jump in with the questions like when you have it, so that we don't get too far along before you have to wait. So without further ado, Rob, thank you so much for joining us, and take it away.
Thank you. I'm going to share my PowerPoint slides. And can everyone see those?
Yes.
Yeah. And Rob, if you go to slideshow on the
Yep.
top. Yeah, oh, got it. Okay.
So today we're going to talk about understanding financial statements. And again, this is like Anita said, I have bachelor's and master's degree specifically in accounting. So we're going to try to capture in 2.5, 3 hours, a lot of information. So we go fairly fast. There's a lot of material here. It'll give you a basic introduction of the basic financial statements. And if you have any questions as we go, please chime in. We talk about accounting is the act of gathering and reporting financial information of a company. We capture the financial data, we organize it, and then we produce financial reports. In my career, I've seen going from pencil and paper to QuickBooks. So every one of you have the ability to run an income statement, a balance sheet, in literally a matter of seconds, instead of having a team of accountants prepare all that data for you. So that's a huge advantage. Probably 99.9% of our clients, which number in the hundreds, use QuickBooks for their basic financial accounting. Accounting is an art. It's not a cast in stone science. In the past year alone, we've dealt with a lot of different issues, dealing with how to account for PPP loans, when to show forgiveness, how to show forgiveness. It's very different for for-profit companies versus for non-for-profit companies. The accounting is very different. And that's something that's new, that just literally didn't exist 2 years ago, that the accounting profession, the industry, has had to come up with a way to account for things like that. Now we're dealing with the employee retention credits. If you don't know what that is, you should be talking to your accountant or your payroll service to see if you're eligible for employee retention credits, because we're seeing a number of companies that are unaware of these, and there's quite a bit of money, again, free money available from the government, depending on what your sales has done during the era of COVID. So if you don't know what an employee retention credit is, please contact your accountant, your tax preparer, or your payroll person to see if you're eligible for that. Accounting is a service activity. That's something accountants struggle with. We don't make the product. We don't contribute directly to producing product, unless you're someone like me that's in the accounting industry. Its function is to provide information for other members of the company. Who uses financial statements? The most important is you. You need to use financial statements. It's too often I'm literally sitting down with somebody on April 14th telling them whether they made money last year or not. That's way too late to know that information. You need to know that information as soon as you do business so that you can adjust accordingly. We do another seminar every year on cash flow, and that's important to understand that you need to react sooner rather than later if something's going good or bad. And then all sorts of external users use financial statements. Potential investors, creditors, if they want to grant you credit, taxing authorities, regulatory authorities, customers, unions, all sorts of external users. Again, the primary external user of your financial statements will be a bank. If you're looking to do any financing, they're going to want to look at financial statements. And then again, financial statements provide the information you need, granting credit, making investments, borrowing money, adhering to regulations. We do a lot of work in the nonprofit business where what they spend money on is important, and reporting what they spend money on is much more detailed than even their tax reporting. Determining how much employees should get paid, executives, evaluating competition, evaluating potential litigation. Those are things we use financial statements for. Business activities are going to determine what your financial statements look like. It looks like we have across the board today: service, manufacturing, retail, wholesale. Governmental financial statements are like no other financial statements, and nonprofit financial statements are very unique as well. In a type of business activity you have will have an influence on what your financial statements look like. So we're going to talk about three basic financial statements today: the balance sheet, the income statement, and a statement of cash flows. Many of you probably routinely look at income statements on QuickBooks. You probably don't look at your balance sheet enough, and few of you probably look at a statement of cash flows, which is an important statement of cash flows. They also refer to that as the banker statement, because that's the statement the banker is most interested in, is your cash flow statement. So the balance sheet shows the relationship between assets, liabilities, and equities. It lists all your balance sheet accounts, all your assets, all your liabilities, and all your equity accounts. It's the thing to remember about the balance sheet is that it's at a point in time. If we're looking at your December 31st balance sheet, it's literally at midnight, December 31st. That's where the numbers count. It could be drastically different a couple days before. It could be drastically different a couple days after. So the balance sheet, its biggest limitation is that it's a millisecond point in time of your listing of your assets and liabilities. And again, the old accountant's rule is debits have to equal credits, assets and liabilities, and stockholders' equity must balance. That's gotten a lot easier with QuickBooks because QuickBooks won't let you get out of balance. The income statement is literally your report card. It reports your success or failure for the companies during the period. You can run income statements in QuickBooks by the day, by the week, by the month, by the quarter, by the year. Any period of time, you can run an income statement in QuickBooks. You can also compare it to the identical period of time in prior years, especially if in a seasonal business. That's important. Loss.
Rob, we're losing you.
The cash flow.
Is anyone else having issues with the audio? Can you please put your response in chat, please?
Yes.
I cannot. Rob, we can't hear you.
Okay, how's that? I think I lost connection for a minute.
Okay.
We're back online.
Okay, we'll just keep track of it. Thank you.
Okay. So the cash flow statement really explains what happened to your cash depending on what happens at various accounts. And as we'll look at that later in detail, and you'll get a better understanding of what the cash flow statement is. One thing you hear accountants talk about it are generally accepted accounting principles. That's GAAP.
Rob, we don't have your PowerPoint, or at least I don't.
Okay, boy, I don't know what's going on. I lost connection. So let me, is that better?
Let's try that.
That's fine. That's fine.
I think
You can
it's
see that now? Okay.
Yes, yeah.
All right. Hopefully my internet must have cut out for a minute. So when we talk about generally accepted accounting principles or GAAP, that's how we determine how to account for things, when to recognize revenue, and what to disclose in the financial statements. Probably very few of you get full financial statements from your accountant. But if you do, you'll see that the basic financial statements are 3 or 4 pages, and your footnotes could be anywhere from 8 to 15 pages. And that's the disclosure part of the financial statements. Valuation is a big issue, and that's something that's changing all the time. For the most part, we account for things at what you paid for. There's more and more push to do more fair market value reporting, but accountants are very comfortable with cost. So your fixed assets, we're going to record what you paid for it when you bought it. We're also dealing with the influx of international versus U.S. accounting standards. Those are a few years away from affecting smaller businesses. Eventually they'll get here, but I think the U.S. is the one country in the world that's resisting implementing international accounting standards for small businesses. So it'll be interesting to see what happens to that going forward. Recognition: how should an item be treated in the accounting records? For those in the construction industry, how do you account for your work in process? When do you record your revenue? When do you earn your revenue? Disclosure is, like I said, adding all those footnotes, and we'll talk about some of the basic disclosures a little bit later. The form of the organization, whether you're a sole proprietorship, a partnership, a corporation, nonprofit, governmental, have a big impact on what your financial statements look like. QuickBooks even has various packages for nonprofit organizations and for-profit organizations. And then the notes provide additional information. Many of the notes have nothing to do with numbers. They talk about how you're accounting for things, how you're recording things, and they don't even have a number in the footnote. What does an auditor do? So an auditor is a professional accountant that comes in and does an independent examination of your accounting data, and then we issue a report on it. Most of our audits are nonprofit audits. Any nonprofit organization with $500,000 in revenue, which is thousands of them, require an audit every year by either the federal government or the attorney general. We simply give an opinion on your financial statements. There's other levels of service that we provide, review and compilation. If your bank requires financial statements, that's when you'd have to hire an outside CPA to prepare those financial statements. Other things we talk about when we're preparing financial statements is that we're concerned about relevance. We don't want to spend $1,000 tracking a $100 item. We want to spend our time on things that are important for you to make decisions based on. We want them to be reliable. We want you to trust them. We want you to be able to compare them from year to year or month to month. So we want to be consistent. We want to treat things the same every year. That's something that's very important, especially when you start looking at the comparative financial statements. We talk about a time period, and that time period is entirely up to you. Your tax return is going to be based upon a year. But you can look at financial statements, like I said, on a weekly basis. When I worked at Friendly Ice Cream, we looked at financial statements on a weekly basis, and we compared them to the same period the year before, just to see how different number of restaurants were performing. Going concern. We prepare financial statements assuming that you're going to exist for more than a year into the future. We depreciate your assets over up to 40 years because we think you're going to be there for 40 years. If we don't think you're going to be around, that's something we have to deal with and account for differently than if we consider you a going concern. Again, cost principle, most of your assets are going to be recorded at cost. And then the full disclosure principle, a complete set of financial statements includes the footnotes to the financial statements. Many of you probably have never seen those for your company, but that's when you'd have to bring in an outside person to help you out with that. We talk about the different accounting methods. Accrual, we record revenue when it's earned. If you bill somebody for work you do in December, we show that in December. Same thing with the expenses. If you spend some money in December, but you don't pay for it until January, we show that expense in your December income statement. Most of you probably deal on a cash basis that you consider it revenue when you collect it. You consider it expenses when you write the check. The cash basis is important because that's how most people prepare their tax returns on. So let's get into the individual financial statements. Any questions on general issues before we get into the detail of the financial statements? Okay. So the balance sheet generally contains the following standard classifications: current assets, long-term investments, property, plant, and equipment, other assets, current liabilities, long-term liabilities, stockholders' equity. All right. The balance sheet, the format, we show the assets as a total, and then we show the liabilities separate and the equity separate. And the liabilities and the equity have to equal the assets. That's why it's called the balance sheet. And again, this is at a particular point in time. You could produce a daily balance sheet if you wanted to keep track of your cash, your payables, your receivables.
Rob, can you tell us the difference between current and long-term?
Yep. Yeah, I have a slide on that. Yep. We'll talk about that. So again, the assets equals the liabilities must always balance. That's what most accounting jokes are based upon, that we have to stay in balance. So current assets are assets that are expected to be converted into cash within a business cycle or 1 year. And those are things like cash, short-term investments, receivables, inventories, prepaid expenses. So those are liquid assets that are either cash now or soon will be cash. Cash is, again, money in the form of cash, bank deposits, could be money market accounts. We move things into short-term investments. If you open up a CD or some type of money market account, we may call those a short-term investments if it's a little less liquid than cash, but still easily convertible to cash. Inventories are the goods, either your finished goods, your raw materials, your work in process. If you have inventories, those are one of the biggest things to keep track of. We're in a situation now where accountants hate inventories. We want to tell you to minimize your inventories, but we're finding the phenomenon now is that people are building up their inventories because they're worried about the supply chain situation. So they're holding more inventories than they normally would. Again, the thing you have to understand about that is the more inventory you hold, the less cash you're going to have. Many of us don't have finished goods or raw materials, but we have what's known as work in process, especially in the service industry and the construction industry. That's for the work we do that we haven't billed yet. We may bill somebody over time. Some of our jobs last 6, 7, 8 weeks on some audits. And that's all time being built up that we haven't billed yet. And again, that affects our cash flow. Retail stores have finished goods inventories. Manufacturing have all three of these. They start with the raw materials, then it moves the work in process while they're working on it. And then when it's done, it's moved to a finished goods. Prepaid expenses are the amounts an entity have already paid for services. The biggest one of this would be insurance. If you're paying your insurance on an annual basis, we'll park that on the balance sheet as a prepaid expense. And then monthly, we'll take 1/12 of that off your balance sheet and move it to your income statement so that every month shows 1/12 of your insurance expense. Accounts receivable, the amounts due from customers on credit. Because all customers don't pay their bills, we usually set up a allowance balance for bad debt to show what we don't collect. Again, accounts receivable on your balance sheet, everything is considered good. If you're like us, you have your receivables aging will go anywhere from customers who pay you immediately to customers who pay you the next time they need you, which could be a year away. And so those are all things, again, all affecting cash, which we'll talk about in the cash flow statement. Non-current assets include primarily property, plant, and equipment. You're going to buy a car, that cost is going to go on your balance sheet. And then if you think you're going to use that car for 5 years, you're going to take those 60 months, and every month you're going to transfer 1/60th of that car cost from the balance sheet to the income statement. So at the end of 5 years, the cost of that car on your balance sheet will be zero. And the full cost of the car would have been spread across your income statement every month. And again, we could talk for a full day just about the concept of depreciation, but understand the fact that while many of us treat it for tax returns, it's really the allocation of the cost of an asset over its useful life, just spreading it out. And again, land, buildings, equipment, furniture, fixtures. We're putting a lot less into property, plant, and equipment than we used to. Most companies, if it's less than $1,000, some even $5,000, they will not put it on their balance sheet. They'll immediately expense it. A lot of you being new businesses or small businesses, you're probably still putting things on your balance sheet and depreciating them over the time. Intangible assets, we'll just briefly mention. If you've been around a while, you may have them. These are things that there's no physical existence. If you buy another company, if you franchise, if you get a patent, if you have a trademark, you're going to put the cost of those assets on your balance sheet and then spread out the cost, just like depreciation. We call it amortization. We're going to spread that out over the life of those patents, that goodwill, that trademark. Again, most of you won't get into that until you're a very mature company. So that's the asset side. Next is the liability side. And again, first, we're going to start with current liabilities, liabilities that are expected to be paid by the business within a short period of time. They're usually listed in order of liquidity. Accounts payable, accrued liabilities, short-term borrowings like lines of credit. If you have any unearned revenue, meaning people that you've billed for in advance, your prepaid insurance on your balance sheet is the insurance company's unearned revenue on their balance sheet. Like you expense your prepaid insurance over a year, they'll amortize their unearned revenue and show it as revenue over the course of the full year. If you're billing somebody in advance, you'd put it on your balance sheet until you earn that money, and then you'd move it to your income statement. Specific liabilities, accounts payable, that's the amount you owe to suppliers for goods. Trade payable, trade accounts payable. Again, a lot of small businesses get into trouble because they enter it into QuickBooks when they pay it. And we want you to enter that into QuickBooks as soon as you get the bill. And then if you're going to pay it 30 days later, use QuickBooks to pay it 30 days later. That'll give you a much more accurate financial statements. But that's a problem. Probably 75% of small businesses won't put that into the computer. And it's a little bit psychological until they're going to pay it, where you ought to be putting that bill into your QuickBooks as soon as you get it in the mail and then pay it when you normally would pay it. Accrued liabilities, these are amounts that you may not have a bill for yet, but you want to recognize as expense for the period. So you'd put them on your balance sheet, recognize the fact that you're going to be paying them in the near future. You have to remember that a Fortune 500 company literally closes their books the third day after their year end, and they don't have all their bills yet. They don't have all their information yet, but they're making estimates, and they're completing their balance sheet and their income statement based upon those estimates. And these are the United Technologies of the world and the Walmarts of the world that are able to get their balance sheets done literally 3 days after the end of their accounting period. And that's how you would do it, be much better than getting it done quicker as well, is using some estimates. Again, one problem small businesses have is that they don't get around to looking at the month of December, sometimes until February. And by that time, if something was going off the rails in December, it probably continued to go off the rails in January, and you're just not aware of it yet. So that's why we want you to keep your books just as up to date as possible. How important it is to keep your books up to date, so you can be looking at these reports almost on a weekly basis. Short-term borrowings are primarily lines of credit that you're going to have with your bank. Many of you, as you get established, you're going to have a line of credit that's due on demand. So that's why they're put in current instead of long-term liabilities. We talked a little bit about unearned revenue, and there's a example here with Fortune Magazine that you're paying your annual subscription over a year. So you're going to spread that expense over the year. They have to spread the income over the year. And that's how they do it. Long-term liabilities, again, we talk about warranties, employee benefit plan liabilities that you probably don't have, but you do have you probably will have long-term debt. And you probably do have leases. Leases is a concept in accounting that's changing drastically. And if you do have an outside accountant preparing financial statements for you, that's something that's going to change drastically over the next 2 years. That really came out of international accounting standards. And the U.S. accounting standard setters have said that they want that applied to everybody before 2023, which includes you. So if you're producing generally accepted accounting principle financial statements, your leases are going to be accounted for differently than they are now. And then long-term debt is the 3-year, 5-year, 7-year notes that you get for your bank. It could be a car loan. It could be a mortgage. It could be any number of things. And that's considered long-term debt because it's not due within the next year. Warranties are if you're giving guarantees, you're supposed to put an estimate of what you think that'll cost you. If you think of Ford Motor Company, when they sell you a car, they're promising that nothing's going to go wrong for 5 years. So they're recording what their estimate is of expenses that they're going to have to pay for. When they sell you that car, they're estimating how much they're going to have to pay over the next few years to back that warranty. And they put that on their balance sheet, and they lower the profit that they're going to show from that car sale. Again, something most of you probably won't get into. We have a couple smaller clients that have warranties that we do an estimate for. And again, as you can imagine, it's hard. Employee benefit plans. Again, most of you probably don't have employee benefit plans, but understand the fact that we have a number of small businesses, especially legal and medical practices, that still have full-blown pension plans. And the accounting for those is very complicated and really change your financial statements drastically. But I think most of you won't have to worry about that. And long-term borrowings, again, they do not have to be repaid within 1 year. Stockholders' equity is the difference between assets and liabilities. That includes the money that you initially invested if you bought stock. It also includes any additional money that you put into the company. More and more companies are having different classes of common stock and preferred stock. They do this as a way to give people an equity in the business, but they have classes of common stock or preferred stock because they don't want to give up control in a business. So someone could own 1% of the stock and still have complete control of a business if they use different classes of stock. Retained earnings is all the money that you've ever made that you've kept in the business. So it's the net income generated from day one less any money that you've taken out of the business as dividends. Any questions on the balance sheet?
Rob, where does PPP and idle money go?
Yeah, so PPP sits on your balance sheet as a loan until it's forgiven. Okay, same thing with the idle grants would sit on your balance sheet until it was forgiven. The idle grants were blanketly forgiven last year, so that was immediately recognized as income. The PPP loans, you have to go through a process of getting it forgiven. So if you had a $50,000 PPP loan, that would show under notes payable on your balance sheet as a liability until the day you got it forgiven. And then when you got it forgiven, it would be taken off your balance sheet and put onto your income statement as income, $50,000. That's further complicated by the fact that that's going to show on your tax return as book income, but not taxable income. I had talked to a client yesterday that their book gap income this year is going to be $230,000. Their taxable income is going to be minus $10,000 because of all the adjustments that are being made because of the idle and the PPP loans. So that's something that, really matters when you get it forgiven and things like that. Some companies are sitting on a lot of cash because they theoretically qualified for forgiveness of the PPP loan, but many of them could have survived without it. So that's, something interesting to watch. We're still getting round 2 PPP loans forgiven. Other things were restaurant revitalization grants, but those were grants from the outset. So they immediately went to income, but they weren't taxable. We had some restaurants that got PPP1, PPP2, EIDL, and restaurant revitalization grants. And again, some of them are, thrived during COVID because they had a readily adaptable takeout market. So it's really, interesting to see how businesses have done during COVID.
So Rob, it appears on the balance sheet then in that it is an asset?
Nope,
Because-
it's a liability.
No, I know, but let's say the PPP, it's a liability and then it's forgiven and it winds up.
So then it goes to
on
the income
asset
statement.
Under cash, right?
Right. It goes to the income statement as retained earnings. And then if you still have the cash, it's showing as your cash balance.
Got it.
Yep. And again, like I said, now we're going through the round of the second PPP forgiveness. Excuse me. And again, especially as we get towards a year end, we have the debate in the office all the time. Should we be showing it as forgiven as soon as we think it's forgivable and move it to income at that point? Because it could make a big difference on your year-end statement. That's especially true with nonprofits who are very sensitive about how much, in quote marks, profit they're showing. And but they eventually have to acknowledge that these PPP loans became grants to the nonprofits. And the EIDL is a whole new, whole different story because people get those. And now there's a whole new round of EIDL loans that people are getting. But those are loans. They're going to be liabilities, and you're going to pay those back. We haven't found anybody that I've dealt with that wasn't 100% forgiven on PPP loans, because there are ways to make that happen, especially when they moved it from 8 to 24 weeks. Everybody has gotten those loans forgiven. Okay. So the income statement. Talk about a couple principles first. And for many of you, these won't impact you depending on what kind of business. Like the construction business, this impacts you. When do you earn the revenue? The customer may be giving you deposits. They may be giving you cash. You may be billing them and waiting for your money. But when do you show it as revenue? And the answer is when it's earned. The service has been provided. The goods have been delivered. An exchange has taken place. You're also reasonably certain to collect the revenue. This is something that we've really struggled with on the industry wide, especially looking at some larger businesses, or when some of these things are sold that have extended warranties, have contracts like a cell phone. When do you earn that revenue? Is it at the point you give them the cell phone, or is it over the time that they keep that account open? The format of the income statement, we go from net sales to cost of sales, and these are the costs directly in that you use in production of the project. That gross margin line is critical. When you look at your industry, as we get into this more advanced, your accountant will talk to you about comparing how you're doing against competitive industries. There's all sorts of databases that are available. When we do the valuation of a company, we look at your gross margin versus the gross margin of other entities in your industry to see how much you're worth. In a manufacturing company, the cost of sales is easy. You know, it's the direct labor, it's the raw materials, it's the inventory costs. In a company like ours, the cost of sales is the payroll, is our cost of sales. And then after gross margin, we come down to selling, general and administrative costs. Those are things like outside services, office supplies. It might be the rent of your office building. That comes down to operating income. Normally, other income and expenses have not been a big deal, but in the last couple of years, that's where the PPP loan forgiveness goes, because we don't want to contaminate your operating income with things that aren't going to happen again. So we keep your operating income consistent. We talked about that earlier. We're calculating your operating income the same way we've done for the last 10 years. And then if there's something unusual, we're going to show it down in other income and expenses, like a PPP loan forgiveness. Finally, income taxes. Again, many of you are pass-through entities that the company, the entity itself, doesn't pay the income tax, that you pay it individually, whether you're an S corp, a partnership, a sole proprietor. But in a regular corporation, income taxes is a big component of the net income line. I always talk about Ebitda because they talk about this all the time. What's your Ebitda? It's used in valuations. And this is just a simple, just point of interest to throw it out there for you. You start with your net income. You add back interest, taxes, depreciation, and amortization. That's your Ebitda. It's really a shortened version of cash flow from your operations is really what they're trying to show there. And again, that's something you got to compare to companies equivalent to yours to see how valuable you are. So when we talk about revenue, you know, the purest definition is, you know, it's an increase in net assets because of your operations. We talk about sales used by merchandising entities and manufacturing concerns. Sales of services or total billings. We use billings as our revenue number. Banks have interest revenue. Real estate agents, insurance, brokerage firms have commissions. That's their revenue. Insurance companies have premium revenue. It's all the same concept. Most of you are just simply going to call it sales. Then we segregate out gains and losses. These are things that you might make money on or lose money on that don't have anything to do with your business. If you use a car for 5 years and then sell it, the amount you get from that is not included in your revenues. The fact that whether you did a gain or loss is shown on your income statement, again, below the operating income line that we talked about earlier, because we don't want to literally contaminate the operating income line. We want that to be truly from your operations. So if you're getting any gains or losses, we show them at the bottom of the income statement, just to acknowledge the fact that that's not what you're in the business of, is making money selling cars. I have a nonprofit that leases cars, and then the market is such that they buy out the lease and then they sell the car. And last year they literally made $250,000 selling. You know, they have a 100 lease fleet, and they literally made $250,000 selling off cars that they had leased and then bought. That's not included in their revenue. That's put at the very bottom of their statement of activities as gains or loss to show that it's not ordinary. So again, the income statement is literally your report card for a period of time. If we're doing this live, I'd ask you how often do you look at your income statement? We look at our income statement monthly at our firm. Like I said, when I worked at Friendly's, they did it weekly. I have a daughter that works for Walmart. They look at it daily. They look at an income statement and they compare it with days and prior periods to see how they're doing. They're cyclical to the point that they know when people get Social Security checks because their sales get boosted on those days. So it's really, they look at it in that finite a period. And again, it summarizes all the revenue and expenses that you have for the company for that period. It's essential that your books are up to date. It's essential that you've done all your billing. It's essential that you've recorded all your bills, even if you haven't paid them yet, because that's important to see if you've made money or not. And again, I can't stress how important it is to keep things up to date, because that's when you get accurate financial statements. The financial statements are only going to be as good as you tell them, as the information you give it. Something the accountants talk about all the time are the matching principle. And this hopefully will better explain why we do what we do. It requires that expenses be recorded in the same period in which the revenues they help produce are recorded. So again, the biggest examples of this are retirement benefits and depreciation. Retirement benefits, if I'm making a promise to you that I'm going to pay you some money 40 years from now, I need to record that expense when I'm earning the revenue that you're producing for me. So that's why the retirement benefits, very few small companies have retirement plans, full pension plans, but some still do. And the accounting for them is complicated because we have to estimate how much those benefits are worth in today's dollars. The other best example of the matching principle is depreciation. You're going to buy a machine and use it for 7 years. If it's a construction company, it might be a Caterpillar piece of equipment or a payloader or a bucket hoe. And you're going to pay for that piece of equipment, put it on your books, and you're going to use it for the next 7 years, and it's going to produce revenue for you. So because we're producing revenue for the next 7 years, we want to put the cost of that piece of equipment over the next 7 years as well. And that's what we do with depreciation. If we think that piece of equipment is going to last 7 years, we spread the cost of that equipment over the 7 years. We're going to take 1 month, 1/84th of that equipment, 7 years, 12 months, every month. And we're literally going to take it off your balance sheet and put it on your income statement as depreciation expense. And at the end of the 7 years, that piece of equipment is going to be worth zero on your balance sheet. And the entire cost of that equipment would have been spread over the time that it was producing revenue for you. That's even a more difficult concept because what does the IRS let you do? The IRS now lets you fully expense pieces of equipment up to literally a couple $1 million immediately on your tax return. If we were keeping your books on the generally accepted accounting principles, we would still depreciate that, even though it's long gone from your tax return. So that's another concept why the tax return has some limited benefits in terms of the financial statements that it contains. Other conventions, again, we talk about we don't want to record revenue until you've completed the earnings process. We want to follow the earnings of the revenue, salaries of administrative staff. We book as we pay them. And then we could talk about systematic allocation processes. That's depreciation, okay, is an example of an allocation process where we're allocating the cost of that equipment over its useful life on the income statement. Different concepts for expenses. Again, the consumption results in a decrease in net assets, meaning you're writing a check, okay, or you're booking an account payable. Cost of sales, the expenses associated with the cost of the merchandise. Rent expense, cost of renting offices. The accounting for that's going to change if you have a long-term lease. Depreciation is the cost of using those long-term assets over their useful life. Where do companies get into trouble? Some of the biggest accounting scandals, you talk about WorldCom, Enron, Waste Management has had issues where they've shown revenue ahead of when they should have shown revenue. They've shown expenses long after the fact that they were incurred. And Enron introduced the concept of off-balance sheet liabilities. Enron, it was a company that literally was doing things accounting-wise that had never been done before. And for the 5 years after Enron went out of business, accountants were dealing with coming up with better rules that would have prevented that from happening. So again, we talk about the PPP loans now has generated new decisions that the accounting industry has to make to how do we account for things. Okay. You accelerate revenue because you want to appeal to your bankers. Some people accelerate expenses because they want to pay less taxes. So those are all things that we can get into trouble on in accounting. We talk about common size financial statements. Is that once you have good financial statements, you can compare them to other companies which aren't necessarily your size. And we do that by converting everything to percentages. The balance sheet, every item on the balance sheet, we turn into a percentage of assets. So your assets are going to add up to 100%. Your cash might be 23% of your assets. It might be 1% of your assets. We do the same thing with the income statement, that everything is converted to a percentage based upon a total revenue. So your gross margin might be 26%. Your rent expense might be 4% of your revenue. And we do that because there are literally databases filled with those percentages for other companies in your industry. There's a source, you can go to any reference library and Robert Morris Associates, and they have a whole book that's just page after page after page, that if you're a restaurant, you can look up restaurant and see what your standard percentages should be. If you're a construction company, if you're a certain type of service organization, an accounting firm can go look at every other accounting firm in the world and compare what our percentages are. We want to know, are we spending too much on labor? Are we not spending enough on labor? And that helps us do that when we start to convert that to what is a common size financial statement. Any questions before we go to the cash flow statement? So again, the balance sheet's at a point in time. Yep.
Oh, hi. Yeah, I just wanted to ask, is there a place for, I don't know, someone online that can that would be a good place to go to learn QuickBooks?
Yeah, there's all sorts of places. There's local bookkeepers. QuickBooks has tutorials available. If you go to Intuit, which is the QuickBooks company, there's literally the QuickBooks for Dummy series. The best thing you can do on QuickBooks is to sit down with somebody who's experienced. We find that most people can grasp the concept of QuickBooks very quickly if they're sitting next to somebody, that can take them through the hoops. We're doing more and more QuickBooks Online versus QuickBooks Desktop. QuickBooks Desktop has a big advantage because it's been around forever. The experienced people know how to use it. So a lot of people still prefer QuickBooks Desktop. QuickBooks Online, the problem, like people like me don't favor it, is because it's different. It's and I don't know why it's different than a desktop. That's just how they've chosen to done it. So it's a little bit more cumbersome for us to deal with. The big advantage of QuickBooks Online is there's a feature in it. You invite your accountant to join. And the biggest advantage of QuickBooks Online is you could be where you are, I could be where I am, and we could both be looking at your QuickBooks file, and we can both take over and control it. So if I needed to show you something, I could show you while we're both on the screen for no matter where we are. So that's the big advantage of QuickBooks Online. The disadvantage is if you're a new QuickBooks user, go to QuickBooks Online. Don't go to the desktop, because then it'll be harder to transition to online. If you've never used QuickBooks, you should sign up for QuickBooks Online. They want everyone to be on QuickBooks Online because it involves a monthly fee. I was at a client yesterday that's still using QuickBooks 2013. So QuickBooks hasn't gotten a drop of revenue from that client for 9 years. They want to stop that. They want, we have to update our QuickBooks every year, and we pay them to do that. because we're dealing with people that are using the latest version. So, but the online version, if you're new to QuickBooks, that's where I would start, because then you don't have to transition. And then it's easier to get help if you're online.
And you said that the online one, there's a monthly fee?
Yeah, there's a monthly fee depending on which version you have. And it's not, the basic version isn't that bad. It's gonna, it's probably, it'll take you a year and a half before you pay what you paid to buy the desktop software. But there is a monthly fee, yeah. You're using their cloud. The big advantage of that, like I said, is that you can access it from anywhere on any computer, and your accountant or bookkeeper or whoever is helping you, you can be literally on the phone and talking, looking at the same reports. That's the big advantage of QuickBooks Online. All right. Should we take a 5-minute break?
I think that's a great idea, Rob.
Yeah. So let's take a 5-minute break and we'll start back up at 10 o'clock.
Perfect. Hello, Rob.
Right? Can you hear me?
Yes, we can hear
Yep.
you.
Okay. We'll give them a couple more minutes.
Okay. If you could cover as well, Rob, how to use this information
Yeah,
to,
okay.
make decisions about your next step. Can you afford to let's say, take on a higher rent, or are you in a position to buy a building? Like how you activate the information to help you make good decisions.
Mhm.
Rob, if someone had limited time as a small business owner, which of these reports do you think is the most important one to be reviewing?
Yeah, probably the income statement,
Mhm.
because you got to know if you're making money or not. If you're not making money, everything else is going to go bad.
It's 10 o'clock, Rob. Do you want to start again?
Yep. I'll start up again. Couple comments before we move on to the cash flow statement. Again, Anita asked, the most important statement. And like I said, I think it's the income statement is probably the most important statement. Again, so you got to know if you're making money or not. If you're not making money, everything else is going to go wrong. The other thing is how to use these to make decisions. The next statement we talk about, the cash flow statement, is going to be critical for that. And it's the one statement that few of you and few of our clients, few of most people ever looked at their cash flow statement. QuickBooks will produce a basic cash flow statement, so it is important to look at. But it's highly dependent on you being up to date with your payables, your receivables, and dates are important. If you're entering a accounts payable bill 3 weeks after you got it, you should date it the day you got it, because that's when you owe that money. So dates are critical. You're going to be making decisions. Can you afford higher rent? Can you afford a new building? I like to look at pricing decisions, purchasing decisions, and hiring decisions. These are all things that you're going to use these financial statements for, to see if you can afford more people. For years, we operated on the model is that we would bring in more business and then hire the people. And that wasn't working very good because we didn't know where we could get the people. And we're in a business right now because of the demographics. Accountants are leaving in record numbers. They're retiring. We aren't getting enough young people interested in public accounting. So getting new business is nothing. We actually hired 2 people more than we thought we needed over this past year. And we're now fully booked with those people. So we were able to make that decision earlier to bring those people on. And right now, that's something we're all facing, is hiring people is hard. So can you afford to hire somebody when they're available and then build the business around them while they're working for you? These are all things that these financial statements can help you decide. Purchasing, the biggest mistakes I see small businesses make are they're buying things that they aren't producing. I'm dealing with a client now that wants to build a new maintenance building. And again, I understand why. I understand it'll be better for the company, employees and everything, but it's not going to add a penny of revenue. And you have to factor that in to paying for that building over the next 20 years. He's going to be paying for that building. So that's a tough decision. I think the decision was he can afford it. Okay. But then the next decision is, should you do it? In manufacturing, I've been involved in many manufacturers who see a new piece of equipment coming out and they buy it, not knowing if they're going to have enough work for that piece of equipment. And that's important to understand. And I know it's hard if you're running a business. You see a piece of equipment, you get excited, you look at its potential, but if you don't have the time to exercise that potential, it's better off holding off that decision.
You also
Yep.
talk about the decision when you talk about, I work with a few people in construction.
Yep.
They're trying to understand the timing of purchasing equipment, whether, do you do that December 15th or do you wait till January to do it? So how would you use this information to make decisions?
Yeah,
for timing purchases?
they're looking to take advantage of accelerated depreciation. So if they had in construction equipment this year, the construction companies, like I think our participants said, having a great year. Okay. So they're looking at a big tax bill come April 15th. And one way to reduce that tax bill is to buy a piece of equipment now. Again, if you buy $100,000 piece of equipment, the IRS allows you to fully expense that. You don't have to depreciate it. You can take that $100,000 right off the bottom line. And if you finance that equipment over 5 years, you can still take that full deduction this year, the $100,000 deduction, even though you're not spending $100,000 of cash. So that's why a lot of companies are rushing. Okay. In most years, new car companies advertise, buy that car now, get your tax benefits. Why aren't they doing that this year? Because they don't have the cars to sell. But the construction equipment, any computer equipment, I tell people the general rule, if you're going to need that piece of equipment within the next 6 months of next year, consider buying it this year if you're facing a big tax bill. But understand the fact, when that piece of equipment is making you money and you're paying tax on that money, you're not going to have that depreciation expense to lower your tax bill.
Does that also, the accelerated depreciation, does that apply to things you may buy for rental real estate?
Yeah, it applied. They in the last couple of years, they added it for leasehold improvements, that you can fully expense leasehold improvements.
And
Okay.
how long is that going to be going on for? Do you know?
Well, again, I can't, until
Who knows?
until they say it doesn't go on. We were sweating the first infrastructure bill they just passed did not have much tax provisions in it. The one thing it did do was that it eliminated the employee retention credit for the fourth quarter this year. So some companies who are counting on that aren't going to be able to get that for the fourth quarter. But you can still get that credit going back to last year, back to the first quarter of 2020. That's why it's important to look at that.
Can you explain what it is briefly, the employee tax credit?
So the employee retention credit, if your revenue went down by certain amounts compared to 2019, both 2020 compared to 2019 and 2021 compared to 2019, they're giving you tax credits based upon your employees. It's extremely complicated because it's for what you paid your employees during that quarter. You have to subtract anything that you used PPP funds for, but it could be literally up to $7,500 per employee. Okay. So we're seeing companies, companies our size have gotten $40,000, $50,000 a quarter. I had one client get over $400,000 in employee retention credit if you have a big payroll. So, and it's really, you have to meet those standards that if your revenue went down on a quarterly basis compared to 2019. And that included up to the third quarter of this year. Okay. And I have companies that qualified in the second quarter of last year, the third quarter of this year. It gets even more complicated. If you've earned it in the second quarter of last year, you can get it in the third quarter of last year, even if you don't qualify for the third quarter. So it's very, very complicated, but it's worth the money. Okay. You're going to pay somebody a couple $1,000s to calculate it for you, but it's worth the money, and they pay it fast. You have to file an amended quarterly payroll tax return claiming it, but it's really something that we think is very under the radar for a lot of companies. And we're going through our client list now, reaching out to clients, especially anybody who was shut down for a period of time is gonna earn that credit. So, and it's important. Now that credit's going to be taxable. It's not tax-free money like the PPP, but again, $50,000 in a credit is $50,000. Even if you pay tax on that, you're still way ahead of the game. So those are things to look at. Any other questions before we go to the cash flow statement? The other thing we talk about, the income statement's the most important, but to make the best decisions, you really need to look at all three of these in conjunction with each other, because they're all interdependent on each other. You'll see where the cash flow statement is highly dependent on the balance sheet and the income statement. And like I said, most of you probably don't look at a cash flow statement. Your banker is probably calculating a cash flow statement based upon the information that you give them at the end of the year. So the purpose of the cash flow statement is to convert the income statement from an accrual basis to a cash basis. We talked about the accrual basis. We talked about the cash basis. Most of you keep your books on the cash basis because that's how you're paying taxes. Why is it important to keep it on the accrual basis? Because the accrual basis is the only true way to show whether you're making money. It's putting your revenue in the right month. It's putting your expense in the right month. Not when you collect it, not when you pay it, but when you earn it and when you incur it. And that's showing whether you're truly making a profit during that period. And that's what really matters. You could be having good cash flow, but something's out there that's going to bite you later on, that an accrual statement would help you show you that, where a cash basis statement would not. And again, we're so geared to cash because that's how we file our taxes. We're an accounting firm. We file our taxes on the cash basis, but we look at our books on the accrual basis because that tells us if we're really making money or not. And that's why that's important. QuickBooks does it both ways. You can run a cash basis statement, an accrual basis statement, but the accrual basis statement is based upon you putting your bills in when they're actually earned or due. Okay, that when you bill your customers or when you get billed by a vendor, it's important that it's so date sensitive that that's critical to getting a true balance sheet and a true income statement. And like I said, you can keep your books on the accrual basis in QuickBooks, and literally with the flip of a switch, it'll produce a cash flow statement for you. You don't have to do any additional work. You just have to tell it, I don't want accrual, I want cash, and it'll do it. And you can go back and forth. Our accrual-based statements look far different than our cash flow statements because of our receivables are so high, and we don't have many payables. But we'll talk about that as we go through the cash flow statement. So why do we focus on cash? And I know everyone knows why we focus on cash. It's literally the blood of the business. It's the heartbeat of the business. We talk about investors, creditors, and other parties want to know how much cash. Most importantly is you need to know how much cash you have. And that's important. That's why we do a whole separate seminar on improving your cash flow, okay, which is very, very important. Because you could be making money and run out of cash. Okay, you could be losing money and still have cash. And it's important to know that, because if you lose money over time, eventually cash will run out. So when we look at the cash flow statement, the very top line is net income. And you could make $100,000 of net income, but your cash could go down for the year. And the cash flow statement is going to tell you why. You could lose money for the year and your cash could go up for the year. The cash flow statement tells you why. That's why, again, we talked about it. It's also known as the banker statement. And if we were live right now, I'd ask for a show of hands how many people have ever looked at their cash flow statement. And 99% of you would not be raising your hand. And like I say, QuickBooks will produce a cash flow statement. So if you're looking at QuickBooks, you can play around with that. So again, this is where a big decision-making statement is. The cash flow statement, this is why bankers want to know. It'll help predict your ability to generate future cash flows. It predicts whether you can pay dividends or meet your obligations. The reasons for the difference between net income and net cash. The investing and financing transactions during the period. The statement of cash flows. How did cash increase when there was a net loss? If is cash flow greater or less than net income? How was the expansion in the plant and equipment finance? The cash flow statement is going to tell you what equipment you bought, and it's going to tell you how you paid for it. How much debt was paid off last year? That's going to be on the cash flow statement. The balance sheet's going to show what you have for debt at December 31st. The cash flow statement's going to tell you either how much you borrowed this year or how much you paid off this year, where the balance sheet doesn't tell that. Okay. It tells you how much money was borrowed during the year. It tells about what you paid your stockholders in dividends during the year, which the other statements do not show. Excuse me. So we're going to break this up into 3 separate sections: operating, investing, and financing. For most of you, the operating is going to be the biggest section. And we talk about what normal operating transactions have on a company's cash flow. We talk about from the sale of goods or services, from interest received. It talks about outflows to suppliers for inventory, for employees for services, to the government for taxes, how much you paid for interest, things like that. Before we go on to investing activities, let's talk a little bit more about operating activities. It's going to talk about how much did your receivables change from year to year, and what happens when your receivables go up. What does that do to your cash? When your receivables go up, that takes cash from you, because it means you've literally sold things, you've made profit on things that you haven't been paid for. So if receivables go up on your cash flow statement, that shows as a negative number on the cash flow statement. If your inventories go up, that's a negative number on your cash flow statement. It starts to explain. My wife owns a quilt shop. She has fabric. She has literally several $100,000 worth of fabric. That's all cash to her that isn't available. It's sitting on her shelf. It won't be cash until she gets it out of inventory. So as her inventory has built over the years, that's required cash to do that. Payables going up is a good thing. That means that you haven't paid for things that you've been able to deduct from your net income. All right. So that's all a question of managing. If your accountant sees your accounts receivable going up, he's going to talk to you about that. Okay. Because that's important. We want to know why it's going up. Is it because your sales are way up? Is it because your customers aren't paying you as fast? We want you to know that so that you can act accordingly. Because like I say, we got to keep that cash flow, that blood flow in the business. And the operating activities really tell us on a day-to-day basis where our cash is going. The investment activities and the financing activities really talk about longer term cash flow issues. So the investing activities captures the purchase and sale of assets. That's the big number that you're going to see in your investing activities. Early on in your business, you're going to be buying assets. Hopefully we're at the state now in our business, we're not buying any assets. Occasionally we buy a new computer, and a computer is costing $600 or $700. It's not significant. Okay. We don't need machines. We don't buy buildings, things like that. So we don't have a lot of investing activities. Our cash flow is really determined by our operating activities. If you're starting a business, if you're in a manufacturing or construction business, you're going to be buying new equipment every year. The example I give is I have a company, they're in the propane business. They do a lot of, they're growing rapidly. Every year they buy new tanks. All right. They might buy $100,000 of new tanks. That's an investing activity. They have to decide how to pay for that. Are they going to pay for it out of their cash, or are they going to finance it? And those are the decisions that are going to be reflected here on the cash flow statement. So again, we talk about purchasing property, plant, and equipment. If we're buying securities, if for whatever reason we're making a loan to another entity, but for the primary thing here is going to be the purchase of property, plant, and equipment as a negative cash. Okay. The cost of that equipment is going to come out of your cash flow when you pay for it. It's not going to hit your income statement until you depreciate it. And then finally, we have financing activities. Financing activities capture a company's borrowing and repaying long-term loans and selling or buying back shares from its shareholder. If you're in an S corporation and you pay dividends, that's considered a financing activity. Most of us hear the word dividend and we think of investing, but in the case of running a business, when you pay dividends, you're paying your shareholder just like you were paying back a loan to a bank. And so that's why that's captured into financing activities. The biggest things here are going to be borrowing money and paying money back. And then also, if you happen to be an S corp or a partnership, the distributions you make to your shareholders to either as part of their compensation or as part of their ability to pay taxes. So again, cash inflows, issuance from equity securities. If you're selling your stock, if you're getting new debt, and then outflows are going to be paying your stockholders as dividends and paying your long-term debt. So again, the balance sheet's going to show us what equipment we had at midnight on December 31st. The cash flow statement is going to tell us what equipment we bought that year and how we paid for it. If we bought $100,000 worth of equipment and didn't have any new debt, that tells us that we paid for that equipment out of cash flow. And those are things that the bankers look at. The bankers also look at cash flow to determine, can you borrow more money? Okay. Is there enough cash for you to add another principal and interest payment to your debt? That's why bankers look at this so much, that they may downplay your income statement because they know the things about depreciation and things like that. But what's your cash flow? How much cash is your operations producing? Does that enable you to borrow more money to buy more equipment or to hire more people or to do what you do to finance your business? And that's what the cash flow is going to say that the income statement doesn't show and the balance sheet doesn't show. All right. That's why the cash flow statement's important. And, it's frustrating that people don't look at that as much as we'd like them to look at. Now let's talk about the notes to the financial statements. And I'm sure most of you, again, I'd ask a show of hands, how many of you get full financial statements? And I'm sure it's very few of you. To have truly set of financial statements in accordance with generally accepted accounting principle, the notes are just as important as the balance sheet, income statement, and cash flow statement. So if we're producing an audit or a review of your financial statements, we have to prepare the notes as well. And again, that's sometimes where the real nitty-gritty gets into. Things that are going to be in the notes are the nature of your business. Are these financial statements based upon accrual or cash? What do you consider to be cash and equivalents? And again, do you consider money markets to be cash? That's going to be shown here. It's going to talk about your accounts receivable policies, how you determine bad debt, things like that. Inventory costing, it's going to tell how you account for your inventory. It's going to talk about property and equipment. What's the dollar amount you capitalize, how you depreciate things, what useful lives you do. Income taxes, if you pay them through the corporate entity, it's going to talk about that. If you don't, it's going to talk about that, saying that you're an S corp or partnership and the shareholders pay for the income taxes. Then there's some just weird ones. Advertising is something that over the years has determined that your advertising expenses have to be disclosed in the financial statements as well as how you account for your advertising. This gets, funny to the point that you may have $50 worth of advertising on your income statement. You're now required to have a footnote in your financial statement saying we expense our advertising as we pay for it. We had $50 last year in advertising costs. That's where accountants get frustrated by the standards. If we did full-blown financial statements for your company, we'd be held to the same standards as the accounting firm auditing Walmart or United Technologies Corporation. The same standards for disclosure, the same standards for accounting standards. So that's where it's small businesses that can get burdensome to do that. We talk about credit risks. If you have more than a 10% concentration, meaning that if you have a customer that's more than 10% of your business, we have to say that you have a customer that represents more than 10% of your business. If you're operating in just one state, we have to say, or one region of the country, we have to say that you're operating just in this one region of the country, because the different regions of the country are just totally different economically. We have to put in a standard footnote on estimates. And again, people don't think about estimates when you're dealing with accounting, but think about the estimates we do. They range from the useful lives of our assets. We're estimating that useful life, okay, to the complicated pension If you have a pension plan, think about the estimates that are in that pension plan. On an individual basis, an actuary is basing how long that person's going to work for you, how much they're going to make, when they're going to retire, and when they're going to die when you stop making those payments. Those are estimates that are dramatic and have a big impact on the financial statements. Any type of retirement plan could add 2 or 3 pages of disclosures to your financial statements, involving not only accountants, but outside experts like actuaries. Financial instruments is a whole new concept that really came out of Enron. Is some of these, the derivatives, some of these really funky investments now require detailed disclosure. Inventory, we have to disclose the inventory number on your balance sheet is going to be one number. It's going to be $100,000. In the notes, we have to say that 15,000 of it's raw material, 50,000 is work in process, and a certain amount is finished goods. Why is that important? If you're in an industry that requires hard to get raw materials, we want to know how many you have. If you're in a business that shouldn't have a lot of finished goods, we want to know if you shouldn't have a lot of finished goods. A computer company like Dell should not have any finished goods. They're making their computers to order. The risk of having a finished good is that it's obsolete 3 days later. So that's why they want to know what your finished goods are. If you have any investments, again, if your investments, you're doing good, okay, because you've taken money out of cash and you've put it into things like stocks and bonds, that requires pages of disclosure. Cost and fair market values, types of investments, when they mature, how much you bought, how much you sold for the year, how much they've gained during the year that you haven't recognized yet because you haven't sold them. Again, any investments, which I hope you all have someday on your company balance sheet, requires a lot more accounting issues. But that's a good problem to have. A lot of nonprofits have investments because they built up endowments and they built up, board designated funds. Related party transactions. Any related party transaction, whether it's to another company that you own, if your children are employed, any related party transaction is supposed to be disclosed, no matter how big or small. This is especially critical in the nonprofit world. They want to know if you have a board member who's a lawyer who's also providing legal services. It'll show as legal service expense on your income statement, but in the notes we have to say there's an attorney on your board of directors that received $12,000 for legal expenses last year, because they want complete transparency with these related parties. If 10% of your sales are to a company that you control, that has to be disclosed, because outsiders want to know that. They want to know where your sales are coming from. Any expenses that you've put on the books that aren't payables, you have to show. Long-term debt for every note you have. And for some companies, think about a company with 20 different bank loans, okay, whether it's a car payment or a mortgage. This information is listed in the notes. On your balance sheet, it's going to say notes payable, $1 million. If that's 10 notes adding up to $1 million, all the detail is here. For each of those notes, it's going to show the balance, the term, the interest rate, the payments, the collateral. When does that note mature over the next 5 years? Are there any restrictions, any covenants, which we'll talk about? Any covenants on that note? Those are in the notes. Commitments and contingencies, leases. If there's a lawsuit and if it meets certain criteria, you have to disclose the fact that there's a lawsuit in your notes. It can say that you think you're going to prevail. It can say that, but you have to disclose it. The most common footnotes here are discrimination cases that are pending before the EEOC or the Mass Commission of Discrimination. Those have to be disclosed. Which again, nothing to do with the financial statements, but it's something, if someone's going to loan you money, that's information they're going to want to know. We talked about benefit plans. Again, if it's a defined benefit plan, the notes are extensive. Stock detail, if you have more than one class of stock, this is where we're going to show that. If you're an income tax paying entity, we're going to explain why there's difference between book and tax, which is primarily depreciation. And that creates deferred taxes, which is, again, which is a 3-credit college course talking about deferred taxes. So we're not going to talk about it here. But if you're a C Corp, that's something you may have to deal with. Asset impairment is a fairly new concept. Is that for years, we would put a building on the books and just depreciate it. Whether you were using it or not, we would depreciate it. The overall assumption was the building was probably worth more than what it's on your books for, so no one cared. If you have a piece of equipment that you put on the books for 7 years and you were depreciating it over 7 years, if you stop using that piece of equipment after 3 years, we're supposed to note that that asset is impaired and estimate what that's worth. Okay. And that's something, asset impairment, when I went to school, never heard it. Okay. Now the last 5 years, that's become a huge issue, that asset impairment, again, in that transparency mode, that we want to know that about a company. For nonprofits, a whole new world of disclosures. Donated materials, facilities, and services. They don't have retained earnings. They have net assets. And net assets are either unrestricted or donor restricted. If I give a nonprofit $1 million to build a building to name after me, that $1 million is restricted until they build that building and name it after me. So they can't record it as their money until they do what I've asked them to do when I've given them that money. They also have to allocate their expenses. We talked about cost of sales and selling, general, administrative. They have to allocate, and this is an IRS requirement as addition to a program requirement, is they have to show program expense, administrative expense, and fundraising expense. And again, think about that from an IRS point of view. They want to clamp down on those organizations that are spending 90% of what's given to them on fundraising. And there's a number of organizations you've heard have come under attack for that lately, that if you give someone $100, they want to make sure that most of that's being spent on program, not on administrative and fundraising. So every nonprofit has to report that to the IRS every single year. And those 990s are available to anybody. Any of you could look at any nonprofit tax return that you want. Those are all fully disclosed by the IRS. And you'd see the breakdown of the program, administrative, and fundraising costs on there. Covenants, and these we get into more and more, and it's something we have to deal with in the accounting industry, is that when a bank loans you money, quite often they say you have to pay it back, but you also have to do or not do these certain things. We generally view them as negative covenants, meaning that if you don't trigger that covenant, nothing happens. You just pay your loan back. If you trigger a covenant, the bank has the ability to immediately say that 7-year loan is due today. Okay. And we have to, before we can publish your financial statements, we have to get a letter from the bank saying we're waiving that covenant for the year. And so you can issue the financial statements. We're not going to call the loan because of that covenant. We advise clients that before even they take out some borrowings, there are covenants in there that we don't think they're ever going to make. And we have to tell them that, just so they understand that 7-year loan becomes a 1-year renewable loan, that the bank has the ability to say, I want my money back at any given time. So examples of negative covenants. A dividend covenant may limit the amount of dividends a borrower may pay, meaning it may say you can only pay a dividend for 25% of your profit, so enough for the owner to pay tax on that profit. It may say that borrow funds be used for a specific use, that we're loaning you $1 million, you have to put that into a building addition. But they could also do things like saying you can only pay your owner if they're making $75,000 salary. That's all you can pay your owner unless you get our permission. Those are some covenants that are very common. Another very common covenant is your current ratio. And your current ratio is simply your current assets divided by your current liabilities. In many banks, it has to be 1.2. So if you have 120,000 of current assets and you have 100,000 of liabilities, you'd have a 1.2 current ratio. Okay. And many companies get into trouble because they buy a lot of long-term assets with lines of credits and things like that. And that tends to put their current ratio less than 1.2 or even less than 1. If your current liabilities are more than your current assets, your current ratio is now less than 1. And again, banks don't like that because it shows a current ratio of less than 1 shows that you simply don't have the money to continue, or you're predicted you will run out of money. So we've gone through the slides and we've gone again quickly. So if you have any questions or any other topics that you want to talk about, we can talk about those things. I really, like I said, I can't stress enough that employee retention tax credit, because like I said, I hate to see, some companies took PPP loans and they didn't need them, but I look at other businesses that they would not be open today if they didn't take those PPP loans, so which turned into grants. So, mixed feelings about the government, but it saved a lot of businesses. Like any government program, there's people that take advantage of it that shouldn't. But the employee retention tax credit is something that you ought to be taking advantage of if you qualify. Okay. And like I said, it's headache producing to accountants. Okay. So I can't imagine, just a regular business owner. My wife is an accountant who owns a quilt shop who's no longer an accountant. She doesn't deal with stuff like this anymore. I have to deal with it. And it's but she's going to earn it. It's going to be money. She had to shut down for 3 months. She would not have survived if she didn't take advantage of these things. So we're encouraging people to take advantage of it. Okay. And a lot of people say, well, we're going to be paying for it in the future. You're right. You're going to be paying for it in the future, but you're going to be paying for it in the future, whether or not you take advantage of it. So you might as well take advantage of it. Okay. And go from there. So, and again, I can't, the financial statements, I'm in the accounting business, so I recommend you all have an accountant you can talk to. All right. This is what we do. Most of us enjoy doing it. We recognize the fact that most of you do not enjoy doing this. And that's where we can be mutually beneficial. There are hundreds of bookkeeping and accounting firms around. So, ask around, see, who you're comfortable with. And because they can say a good accountant can save you money and give you a lot of advice. I've been dealing with small business owners for 40 years now, and I worked in businesses. I was controller of a company when I wasn't in public accounting, so I know what it's like to go through. I worked for a company that had plenty of cash, and I worked for a company that didn't have any cash. So I learned how to invest cash, and I learned how to get cash when I needed it. So those are all things that you can talk about. It's important that you have a basic understanding of these financial statements so that you can sit down at QuickBooks and run those income statements. And QuickBooks is marvelous because it's for the money. It's just, it's worth $1 million. You can go back and look at your last 5 years of income statements all on the same screen. You can look at the last 20 quarters. You can look at the last 52 weeks. You can compare this week this year to this week last year if you're in a seasonal business. Think about our business. Our March, April, and May are far different than our September, October, and November. Not as much as it used to be because we're busy, but we're not hyper busy like we are those other months. So it's important to do those. Okay, I'm not sure when you say give me some references.
Probably for accountants.
Yeah, I think you ask around. Ask if you don't have an accountant, talk to your payroll service. Talk to your if you have a bookkeeper, talk to somebody that knows accountants. I'm not going to sit here and say that we're the best bet because there's dozens and dozens and dozens of accountants, and a lot of it may depend on your business, your community, what community you're in. We're in the Hadley area. We have clients literally all over the country. I don't have any international clients anymore. I used to be able to say all over the world, but that's gotten far more complicated. But we have clients in every state. We file tax returns in every state, and we're not an overly big accounting firm. We have 10 professionals, and most accounting firms our size can say the same thing.
Right.
Uh,
And it's interesting because the SBA always talks about having a bail team, which is a banker, an accountant, an insurance agent, and a lawyer. And when we really think about it, just about every question that we're going to have about how to grow or expand our business is going to be, we're going to need the advice of one of those professionals to make those decisions going forward. And, what could people expect to pay for an accountant, Rob? I mean,
it's gonna really depend. I mean,
okay.
yeah. And again, it's like a lawyer. There are cheaper lawyers and more expensive lawyers, and we have a wide range of fees at ours, and we'd best match you. I may not be the best match for you. There might be someone with less experience at our firm that's a good match to get you going. And then, you just call me and, for some big decisions, things like that. Someone asked how do we keep up with current laws and regulations? That's hard, especially if you're like me and I have clients across the base. We're required to do 40 hours of education a year just to keep our license. Our firm standard is that we expect our people to do at least 80 hours a year of continuing professional education. We have some people who have specialized. I have one partner that does nothing but taxes. I have one partner that does nothing but nonprofits. And we kid him that we don't think he should be doing his own tax return. Okay. But he knows nonprofits. And it's hard because everything's changing. Nonprofits are changing. We don't do any governmental work because that's another whole area of specialty. And we just couldn't keep up with it. So we're doing that. So that's how we stay up to date. It's hard. Yeah, it's not easy. So it takes time, and it takes time learning the stuff that we don't can do making money. The employee retention tax credit. I'm probably a level 2 knowledge. We have 3 people at our office that are experts on the employee retention tax credit. Okay, because they're doing the nitty gritty of changing it. For the most part, payroll services are doing this. Check writers, if you have check writers, they'll do it. They're going to charge you for it though, just like we would. But my advice is the first guess would be go look at the revenue requirements and go to your payroll provider. Check writers is doing an excellent job of the employee retention credit. ADP, we were disappointed initially. I don't know if they've gotten better at it, but they were discouraging people from looking at it. And those are the ones that we're doing because we don't do any payrolls in our office. We send you to a payroll expert because that'd be one more area we have to keep up on that we can't do it. So, we don't do our own payroll. That's my tagline. All right. Check writers does our payroll, but there's a lot of payroll services out there. ADP, check writers, Paychecks, and then there's a lot of smaller ones as well. So,
we have some small businesses, Rob, that will start a business using a 0% credit card, right?
Yeah.
Because it's potentially hard to get the financing for the small business in whatever category they're in. So where would that, I mean, the money's due. Let's say it's $4,000 and it's not due until next year for 12 months, no interest, no payments. What happens? Also, there are people getting the EIDL loans and they have no payments due
but they will
18 months. They
right,
absolutely will.
and that sits on your
Where does
balance
that
sheet
show
as
up?
long-term debt until it's not. When you start paying it, that part of it goes into the current debt.
Okay.
Yeah, and that's why it's important to look at the balance sheets because you tend to forget about things like that. And we look at, there's nothing wrong with using a 0% credit card. I tell people when they ask me, I'm buying a car, how much down payment should I give? And if it's 0% financing, don't give any down payment. Okay. But understand the fact that you're going to have to make those payments. I noticed that the 0% down payments are disappearing. The 0% financing are disappearing because cars are scarce. Now cars are scarce. Before, when customers were scarce, you got a better deal. Now you're not getting those deals because they don't have to give it to you. Because they can, if you're not going to buy that car, there's going to be somebody else that's going to come in and buy that car.
Mhm.
We had someone at the office that just bought a car. He was looking at like 5 and 6% for a car loan, and that's like unheard of. I haven't paid a percentage on a car loan in 30 years. I haven't paid interest on a car loans, and so it's really, those are things you got to watch. So there's nothing wrong with using it, but you got to know how you're going to pay it off. And putting it on that balance sheet, it's there every time you look at a balance sheet, it reminds you have $4,000 on a credit card. The problem with the credit card is that many of those, they come back at 18%. when you start paying interest on it. Okay. Yeah. They used to have laws against that. Now they don't. I've seen credit cards as high as 24, 25%. I had one client that got into cabbage, and the interest rates, I think he had one interest rate was, was in the 20%, and that's like, God, just unbelievable. And again, 30 years ago, that was illegal. It's not anymore. So they called it usury. And yeah, but now even some credit cards are charging you 24, 25%. And if you don't know that, you're just getting hammered. Intuit, one-stop shop for credit card processing, payroll services, bookkeeping, and other employee benefits. Yep, absolutely. We have a lot of people that use QuickBooks. You can send your bills online. You can get paid online. They'll do your payroll for you. They're certainly a legitimate payroll service. Okay, so yep.
Interesting. And someone had asked before, it scrolled up though. They don't even think you can buy a desktop version of QuickBooks, but you're saying absolutely.
You could still buy a desktop. Yeah.
Oh, you can. Okay.
Oh
good.
yeah. Yep. We have our server is on the cloud. So we have desktop QuickBooks on the cloud. So if I get a backup from you, we will put that on our cloud, and then I can be anywhere in the world and I can access that QuickBooks desktop, but we can't look at it together. QuickBooks Online, we can look at together. That's the big benefit. And at the end of the year, you don't have to get me a disk or send me a file. You can simply call me up and say, hey, QuickBooks is ready. You literally send me an invitation, and then I have accountants access to that QuickBooks year round. And more and more people are doing it that way. And we'll get used to online. So, because like I said, we'll have to eventually. Yeah, they're not encouraging desktop purchases. Now, someone asked about the top 3 skills for accountants. I think computer skills are probably number 1. Excel, and I date myself. When I started work at Hamilton Standard, United Technologies in 1981, the personal computer hadn't been invented yet. There was no Excel. If we wanted to add up a column of numbers, we either used a 10-key calculator or we wrote a simple program and sent it to the computer center to add up those numbers. We got the first PCs. We got VisiCalc. We learned that, the spreadsheet software, and Excel is the most used software for accountants other than QuickBooks. Again, if you're going to work for a small firm, if you can put QuickBooks on your resume, that's important. But Excel is critical because we do all our work papers in Excel, and you can get into macros and things like that. So that's one of the big things. So, yep. Yes, and I do see the QuickBooks Online going completely online in the future. They tried to do that to the Mac world a couple of years ago, but there's enough outrage that they didn't. But they know, but it's going there because that's what they want. They want to know that every month this is their revenue, not when people decide to buy the new software.
Rob, if someone decides to dig deep and to go forward, getting their numbers right, having greater control, do you recommend that they spend time forensically going back and correcting things? Like, what is someone's course of action?
Yeah,
that's this webinar. They say, "Yep, I'm in. I'm going to start doing it." What's the next step?
I think it's. I don't think it's critical to go back. Understand, and we deal with this all the time. Is that we get someone's act together, and from this point forward, they're going to be good. One problem is we don't have the ability to compare. We don't, when you say, well, how's this July versus last July? If you weren't keeping your books this way, we can't do that. For the most part, we wait the year before we have comparability because again, yeah, this takes time, and bookkeepers are scarce because good bookkeepers get busy. We're in constant search of good bookkeepers because we refer them, and then 2 months later they're saying, hey, stop referring. And we have to go out and find another good bookkeeper. And again, like accountants, there are good out there and there are ones that you should stay away from. But, and again, bookkeepers are important because if you're the salesperson, my wife owns a quilt shop. She wants to create, she wants to sell. She doesn't want to spend time keeping her books. So even she went out and got a bookkeeper to keep her books so she can do what she really wants to do. And that's, to create the designs and the patterns and things like that. And that's important for your businesses too. You didn't get into business to be a bookkeeper. If you did, you should have been a bookkeeper, because you can make a decent living being a bookkeeper or an accountant. Okay. And that's going to get better, not worse, in terms of job market. We're seeing that all the time now. Yeah. That if you have a child in college, it's not bad to counsel them into accounting. Okay. So, because they'll have a job guaranteed coming out of school. Yeah. And yeah, I should have said QuickBooks even does workers' comp. Most of the payroll services now will handle your workers' comp for you. You'll never have to do another workers' comp audit. You'll never have to do any of that, because the payroll services are handling all that. And workers' comp rates are fairly competitive, so that's not a bad way to go. Other questions, comments, things you want to talk about? You're all going to go check out the employee retention credit, I hope.
Yeah, I'd say.
And again, as you get into business, we'll do the cash flow seminar in the spring. That's one I highly recommend, because there's a lot you can do to improve your cash flow. A lot of your decisions affect your cash flow, and that's important. You know, the ability to look at these financial statements are going to help you make so many decisions. Like I said, pricing, purchasing, hiring. Okay. Pricing is a key decision that some of you, some small businesses are doomed. They can't be successful because they're simply not charging enough money. And, the accounting joke is I lose money on everything I sell, but I make it up on volume. That's funny to an accountant because it's not true. Okay. If you're losing money on everything you sell, you're never going to make it up on volume. Okay. So that's the thing you gotta look at. And some people out there are doing that. They're just simply, they can't do it. They got to raise their prices. One of the things we look at when we deal with an oil dealer or a propane dealer that are dealing with constantly changing prices, we say that's how critical your margin is. You have to keep an eye on that margin every day. Okay. Because if you slip under the margin radar, you can lose a lot of money, even though you might be generating a lot of cash. But, the oil market is up and down. The propane market's up and down. All those things are.
And we find a lot with small businesses, Rob, that we tend as business owners not to put ourselves in the equation. So let's say we manufacture something, we're making it ourselves. Let's say we're a jeweler, and we're vigilant about, the price of silver and the stones and everything that went into it. But the 4 hours of labor isn't anywhere in the equation.
Yeah.
And then someone makes a decision to sell that particular necklace for, let's say, $75. Then when they get busy and they're more popular and they make a name for themselves, they have to then bring someone on to help make that necklace.
Yep.
And the labor was nowhere in the equation to start with. So now you have to bring people on. And we see that a lot in restaurants as well, that people have family and friends that are helping them. And so they have no payroll. So they're using the cost of goods, the ingredients, and determining their prices, but it just doesn't, it doesn't provide the money so that when you have to bring people on to help you grow, there's no money to do it. You've accounted for that in the price. So we say to put in a placeholder, assume it's not you. What would you have to pay a cook? What would you have to pay a jewelry assembler? What's the going rate? Put it in just so you know that eventually that's what you're working towards, is getting help to do that.
And it's, especially starting a business is hard cash flow wise. Growing a business is hard cash flow wise, because you may have to rent more space, you may have to buy more equipment, you may have to hire more people. And like I said, in my example, I may have to do that. I may have to hire that person before I get that added revenue. Okay. I may not even have the customer yet, but I need to have that person here so that when I get the customer, I can perform. Okay. So that's hard in periods of rapid growth. We have a hard time saying no. We want, if we get excited by new business, even if we're struggling maintaining our old business, and that's where we have to be better. Okay. We're going through now. The big decision is, should some clients not be using us, and that's a hard decision. Nobody likes to fire a customer or a client. Okay. That's one of the hardest decisions in business, but it's important in the sense that, you might be losing money on that customer. We go through that with 1040 clients all the time. We do a couple thousand individual tax returns. And some clients we don't hear a peep from. They're great clients. We haven't seen them in 10 years, but we're still sending them a tax return every year, and they're sending us a check every year. But then there are other clients that we spend a lot of time with. And those are the ones that we have to charge accordingly. We have to make sure that they understand, okay, that, yeah, you can have all my time you want, but there's a cost to that. And that's hard because we don't like to say no. No business owner likes to say, I'm not going to do that.
Right. That's true.
So the name of my company is Boiselle, Morton and Wolkowitz, and we're in Hadley, Massachusetts.
And Rob, someone asked if we'd be sending the slides out later. Is that?
I think
okay with you?
we can. Yeah, we can certainly do that.
Great.
Yep. And yeah, that's one. This is normally done live, and it's usually done with a group of 12 or 15 people, and it's very interactive. It's very hard this way because I think it doesn't get slowed down when people are. I could see someone if they look puzzled. I can slow down and go through something. I don't have the ability on this one, so that's hard to do that. All right.
Alan, are there any questions that your clients frequently have in terms of their accounting that would be good to bring up? We may have lost him then.
Yeah.
But,
I think you have covered the basics
Yeah, and that's all. That's all I've covered. Is
You really have. And I think the important thing is, and you alluded to it previously, is that you need a professional. You can't do it by yourself. Taxes is very complicated and you need a professional. And as far as the QuickBooks person, they advertise a lot, anybody can do it. Well, I tell you, if you do it wrong, you're going to have an accounting nightmare. It's going to be getting the toothpaste back into the tube. So you better have it set up right to begin with.
I tell people, if you reconcile your checkbook, which you'll be surprised at the people who don't reconcile their checkbook. If you reconcile your checkbook in QuickBooks, we can fix it. Okay. It's when it comes and your cash says 100,000 and you only have 10,000. We can't fix that. We have to make sure. And yeah, Alan's right. It's important to get off on the right start. And yeah, that's perhaps the biggest advantage of QuickBooks Online is that you can call and we don't bill people, and most accountants don't bill people for a 10-minute phone call because we want to spend that 10 minutes now because we do not want to be dealing with this on March 14th or April 14th or, we want when you send it to us, it's ready to go. Okay. We can charge you less money. Everybody's happy. And, so it's important to do it right.
What we like so much about your presentations, Rob, is you're clearly in love with numbers, and small businesses tend not to be as in love with numbers. But when we think about that bail team and those essential people that we need as advisors as we grow our businesses, it's important, I think, that when you speak to anyone, a lawyer, an accountant, insurance agent, that they're people that enjoy developing our education as business owners so that we understand the why of it. Just having someone tell us to do something, I don't think sometimes makes a lot of sense, and it doesn't always sink in. So having someone who takes the time to explain the importance of something, then I think we more easily develop that habit. And so we always say that's that instinct of someone to sort of say, this is why this really would be good for you and your business.
Right.
That's what we're looking for, rather than someone that takes the information and delivers a tax return and never really takes the time to say, gee, I noticed that your revenue was up radically, or I noticed that your expenses just, had a huge spike in June. Someone that's really providing some financial oversight. And I think it's a good question to say, I'm growing my business. Do you provide the opportunity to give me feedback about the numbers, not just report the numbers, because not people have really clean tax returns, but they've never really gotten any direction from the people that have done those tax returns. And we're missing an opportunity there, don't you think?
Yeah, oh, absolutely. You know, the American Institute of Certified Public Accountants, their tagline is trusted advisor. Okay. And that's what we want to be. To 99% of you, we're necessary evil. Okay. We don't want to be the necessary evil. We don't want you to say, oh, I got to call goddamn Rob because I got to do my taxes. We don't want you to be that way. We want you to be, geez, I wonder what Rob or Joe or Fred or, would think of this before I do it. We want to be in that position. And we have all sorts of relationships. We have casual relationships that, might be a phone call a couple times a year. I have one relationship where I go to their board meeting one night a month. I go to their board meeting and sit there almost as their controller. Okay. And again, it's something that they're a bigger company. They're a, multi-million-dollar company. They can afford that. They're not at the point yet where they have a controller. In a couple of years, that's going to be my advice to them, is hire a controller. Okay. But there's a lot of people that are a long way from needing a full-time controller. And we serve that purpose for a lot of clients. So we have quarterly check-ins with, it's whatever you need, whatever you can fit into your budget. Because we do think we can be value added just by looking at those expenses and say, hey, yeah, I went from a landfill company in the trash recycling business to a manufacturer. And my first day there, I saved them almost $40,000 a year because they were throwing away their scrap metal. They were literally paying to get rid of their scrap metal. And they immediately found out. I gave them a source, and they came and gave them a separate dumpster, and they turned that into $3,000 or $4,000 a month of revenue. So it's really, and those are the kind of experience that not only myself, but all experienced accountants have. They know they can look at your insurance expense and say, boy, that looks high. Okay. And things like that. Your payroll expense is too high for your sales. So we can say things like that because we've seen it all, from big company to small company.
We have a question. What is the best place you suggest for getting an internship that covers all the aspects of?
Well, if you're at college now, if you're in school now, the best place is with I think a small public accounting firm. Okay. Because you're going to see a lot of different possibilities there. Most large accounting firms are only hiring people who have interned for them. Okay. Because the competition is such great. Someone like Price Waterhouse will reach out to college students when they're sophomores and try to convert them into interns, only because if they have it as an intern, it's easier for them to convert them into employees. We go through cycles, but we're getting back into the cycle where a good accounting student can pick where they want to go. Okay. Literally can decide what part of the country they want to live in, for that matter, especially if they're at a bigger school that gets the bigger accounting firms recruiting there, like UMass. So, yeah, we don't do a lot at UMass because most of their students want to go to Boston. So we do stuff at like Western New England University and Westfield State University is where we do most of our interns through, because we have a chance of hiring them when they graduate. We don't want to turn them into a better accountant and then have them use that to go work for somebody else. So we do the same thing. We'll reach out early. We've had people as soon as sophomores become interns that we converted to accountants. Okay. And so, it's a good thing. If you're an accounting student, it's a good time to be an accounting student because the jobs are good. Like I said, I have one service I provide to parents. If their kids mention accounting, I tell them they should let me talk to them, because I'll sell them the accounting industry.
Convert them.
Yes. I have one father that's funny because he had 3 kids. They've all become CPAs.
Wow.
I'm still doing his tax return because he says he owes that much to me because his kids are all, very successful, well on their way. So I take some pride in that, is that I still do his accounting. I think it's because he can't choose one of the kids. He'll get in trouble with the other 2 kids, but, yeah. But I do think it's funny. Yep. Yeah. And I know his kids. I've talked to their kids since they've become CPAs. So, yep. Yep. So it's interesting. I have one daughter that became an accounting major. And Alan knows about her. I brag about her. She's currently the controller of Walmart Chile. So the country of Chile, Walmart has a few hundred stores, and she's their controller. She's doing that from her home office in Bentonville, Arkansas, which I think is hilarious. She spends her day on Zoom speaking Spanish. So I can't imagine what that's like. That's high energy, because if you're giving the Zoom talk, it does take energy. But it is interesting. So, and she's one that certainly has had a good career. And again, never has to worry about a job. If she wants to move to Seattle, Washington, she can move to Seattle, Washington, if she wanted to. So, yeah, or any place else in the country or the world for that matter. She has that ability, and that's a nice ability to have, even though if you don't use it. So, yep. And find an accountant who likes what they do. You'll know it when you meet them, because we laugh when we talk to some accountants because they're miserable. And a lot of accountants are retiring. They're retiring early because of the mess we've had the last couple of years. COVID's been very tough on accountants because of the uncertainty, because of the disruption in the tax schedules. And now we're worried about, whenever they mention tax reform, we get worried because that usually means complication, not simplification. So, and like I said, they've, very late in making decisions. That's part of the thing. A week ago, you could do the fourth quarter employee retention credit, not anymore, because they passed that law last week. So, it's gone. That's how quickly it can go away. That's why tax planning is getting very hard. All right. That we have to put a big caveat whenever we talk to you about tax rates 3 years from now, because nobody knows what they're going to be. We know what they are now, and we know if they do nothing, what they'll be, but who knows if they're going to do something or do nothing.
Well, Rob, there don't seem to be any further questions. Thank you so much for your time.
No, I enjoy it. I'll make sure that they get a copy of the
Perfect. That's
file
great.
that can be sent out. My name and company is right on the first page. So, and we, again, I enjoy doing this. We've done this for going way back with Alan, and we sponsor the organization every year. So, we think this is a great organization. We believe in it. And we'd urge you to take full advantage of this organization as well, because there's a lot of good advice out there, and they can help get you going in the right direction.
Thank you so much, Rob.
All right. Thank you.
Have a happy holiday.
Thank you. I'm heading to Arkansas.
Oh, great. Great.
Going to the home of Walmart. So, yeah.
There you go.
Yeah.
Okay.
All right.
Bye-bye. Thank you all
Bye.
for coming.
Thank you.